Hello, I'm Michael Hainsworth. It's being called a catch-22. Large-scale public and private infrastructure investments are needed in Canada, but private developers need private capital to launch, mature, and grow new projects. Investors are reluctant to fund a project when they look at the risk-to-reward ratio. So how do we break the cycle? Meet Sebastien Betermier. He is an associate professor of finance at McGill and the executive director of the International Center for Pension Management. In his commentary, Breaking the Catch-22, How Infrastructure Banks Can Kickstart Private Investment and Overcome Market Failures, he compares Canada's public infrastructure banks to those in Australia, California, the UK, and elsewhere to learn how they address financing barriers for private developers.
Australia has done a lot of these types of public-private partnerships in general to catalyze private capital. The US increasingly has done it. The Nordic countries in Northern Europe and Scandinavia, and the UK. The UK, I think, has one of the longest track record of bringing in the private sector to come in. It's actually quite impressive.
He joins us now. Thank you for joining us.
Hi, Michael.
How big of a catch-22 is this? We've been engaged in public-private partnerships for years, and certain types of investors, like pension funds, love those long-tail projects.
It's big. It's bigger than you think. First of all, if we think about our green transition targets, not only in Canada, but around the world, we're estimating them to be $7 trillion per year for the next 15, 20 years. It's massive. If we think about our existing infrastructure, it's quite aging, actually. And so we have quite large infrastructure needs to fill at a time when governments are actually fairly cash constrained. Now, you're right. When we think about public-private partnerships, we've had a few of those over the past decades. But one point to know about public-private partnerships is that we're not handing over the keys to the private sector. We are helping to build assets managed and owned by the governments, and will bring private operators to build their expertise throughout. So we're not necessarily catalyzing private investments with the hope that the private sector will come in and take over. We're building publicly owned projects and bringing private operators along with us. Pension funds like infrastructure, other investors like infrastructure, but there's a few points that we need to say. One is it's a fairly new asset class. For years and years in the 20th century, pension funds were investing in bonds, government bonds and other bonds. That was enough to pay the pensions. You had a longevity that was lower. You had bond yields that were high, so that was enough, right? But over the years, yields have gone down, bond yields have gone down, so it's harder to get the returns that we need to pay the pensions. Longevity has gone up, so we have more pensions to pay, and so pension funds have looked at infrastructure as an alternative asset class to meet their targets. But when they go into infrastructure, it's important to understand that they usually look for more standard type of infrastructures like toll roads or buildings that we already know that exist, that already have a risk-return framework, that we already get a clear assessment of the risks and the returns. And often when they go, they don't do the greenfield themselves. They go later on at a later stage in the project when the asset has already been built, and then they come in, they purchase, and they continue to operate. So here, as we're looking at a lot of the new types of green infrastructure, we're looking at new markets like battery energy storage, like green steel. We're looking at a lot of needs to fill, and we're looking at pension funds and other investors that are not used to diving into these new types of infrastructure markets because they tend to be risky and complex and new. And so in that sense, long answer short, the catch-22 is large.
You write that infrastructure banks must address several external risks and obstacles, that government commitment is actually one of them. How so?
So I think it's important to take a step back and understand what are the infrastructure banks trying to do. And going back to the public-private partnerships, that's one type of infrastructure investments where ultimately the public sector, the government will own the assets and bring private financing and expertise. The infrastructure bank is a lever that is being used for catalyzing private capital with the hope that the private sector will come in and develop the industry on its own. right? So it's one tool to help, in a way, catalyze the growth of that industry and have it in private hands. What it means is, in order to be successful, we need to make sure that there's government commitments to that industry being owned and managed by the private sector in the long run, right? Think of some of the difficulties that are involved in new infrastructure investments. You may have long permits. You may have regulatory capital charges for banks. So a private investor might come in and say, yeah, you're a bridge financing, that's nice, but I still have all these other frictions that I have to face. And if there's no clear commitment from governments to push forward that industry in private hands, they may still be hesitant to come in. A good example, for example, is think of building toll roads. You're a large investor. You deploy a lot of resources to build the capacity to build toll roads. You build the first. And then 2 years later, the government says, you know what? It's no longer politically acceptable to charge tolls on roads. We're going to ban tolls from future roads. So first of all, your investment is in trouble, right? Because the whole point of investing in that road is to receive the tolls down the road. And even if you protect that one road, but the other roads are banned from having tolls, well, then what do you do with your team, right? You've spent years building a team and expertise. If suddenly you have a lot of regulatory uncertainty about whether or not there's going to be commitment in having the private sector operate, you may not even go there in the first place.
So of the jurisdictions you investigated, which ones seem to have figured out the secret to success?
So among the multiple countries that I've interviewed, I've been quite struck by a few countries. Australia has done a lot of these types of public-private partnerships in general to catalyze private capital. The US increasingly has done it. The Nordic countries in Northern Europe, in Scandinavia, and the UK. The UK, I think, has one of the longest track record of bringing in the private sector to come in. It's actually quite impressive. And if you speak to many of pension funds and other investors, it's quite impressive how many of them have a UK tilt. A UK tilt means they invest more in the UK than perhaps they would otherwise relative to other countries. Think of Heathrow Airport when you land in London. It's owned by the Canadians, funds. Think of Eurostar, right, connecting London to Paris. It's owned by the Canadians. There's a lot of infrastructure in the UK that has been privatized and owned and maintained by the funds. And part of that is proactively reaching out to capital, understanding the needs of private capital so that you can build a framework, making it accessible for them. And three, I would say, building a integrated government framework. One of the points I was actually really most impressed in doing all the interviews for the project was when I was speaking to the UK policy officials, and I was looking at one of the policy goals that they've set a while back called Project Gigabit. Project Gigabit is a policy goal in the UK to make sure that, I don't know, I think it's by 2030 or so, close to every UK household has access to broadband internet, about 1 gigabit internet. And the goal is to do it through private investments. So then the question is, how do you do it? You don't want to spend too much capital in doing a public money if the goal is to bring private investment. So how do you do it in the most cost-efficient way possible? So what the UK did was to say, okay, let's look at the map of the UK. Let's look at the places like London, Manchester, Liverpool, the most urban places where the private sector is already doing it. It's profitable. It makes sense. Why intervene? So let the private sector continue what it's already doing. Then let's look at a second tier region, the more rural areas, further out from the urban centers, where it's potentially investable. It's just lower on the priority line. And if you let the private sector on its own, it's going to take too long to meet the goals by 2030. So then the UK government, and in particular the UKIB, the UK Infrastructure Bank, which now has become the National Wealth Fund, said, okay, let's provide loans to developers to speed up the implementation of gigaband internet through loans, not grants, through loans. So the UK government is receiving money back from these investments so that we can unlock the risk-bearing capacity of the banks and accelerate the policy implementation. And then there's a third tier in the most rural areas where it's not investable. And so at that point, the government is using grants and subsidies to bridge the gap further. and using essentially the most costly use of government capital, of taxpayer money, in where the private sector would not go on its own. So here you have a very comprehensive framework that clearly identifies where to intervene in the most cost-efficient way through loans first and subsidies next, in a very integrated way.
Tell me about the nature of that infrastructure bank environment that has worked elsewhere around the world. What makes some infrastructure banks succeed where others falter? Is it governance or policy?
So governance is absolutely critical. The goal of the infrastructure banks is to crowd in private capital. If you're not careful, you don't have the right governance structure, you face the risk of crowding out the private capital. And I'll give you an example. You are too quick in setting up performance targets. You tell the banks, you've got to deploy. The bank has a lot of levers, such as concessionary capital, so it can make loans at below market rates. The bank will feel the urge to deploy very fast. So what it risks doing is looking at the most easy areas to deploy capital and displace the private sector where the private sector was already doing the job, right? So that's what you absolutely do not want. If anything, in doing that, you're creating almost more of a perpetual market failure, because you're coming in and you're subsidizing businesses that do not need to be subsidized. And so the private sector is not crowded out. So that's hard. If, however, you have the right governance structure, you can essentially channel the funds of the infrastructure bank where it's most needed to bridge capital and bring private sector with you in those areas where on its own it wouldn't. And so for that, you need to have very close contact with the private sector so that you can understand where are the market failures. You need a board that understands both the policy objectives as well as the private sector needs and constraints. And then you need to have a very clear entrance and exit strategies so that you come in, you provide the smallest amount of capital that is needed to bridge the gap, and you exit as soon as the market failure is done. This way, it's almost like you're a firefighter. You are coming in and helping to solve issues. And once the market is solving it on its own afterwards, you move on to a different market. So good governance is central for that. And building a strong, independent framework is also key. Because oftentimes, because these are public bank with publicly set objectives, it can be very tempting for government to say, let's tell the bank exactly where to invest. And that's dangerous. What you want instead is the government to set very clear policy targets at the top. And then you hire a team of experts from the private sector who understand the ins and outs of those infrastructure markets to deploy capital wherever it makes the most sense. And so you're combining, in a way, the very best of setting long-term policy objectives and taking on the risk that the government can afford to take with the expertise from the private sector. And that is very much where you get that winning combination.
One of the criticisms that we often hear when it comes to public-private partnerships is the public component, that we forget that this is about public good. We see examples of policy failure when governments and the private sector get together all the time. In Ontario, you mentioned the toll roads. In Ontario, we've got the 407. We sold it to a private group for a short-term cash injection. Now we don't have the cash. We do have a huge traffic problem. And one of the key solutions being proposed is buying back the toll road. How do we ensure projects are in the public good, not just good for investors?
What's really hard about these infrastructure projects is they tend to be large, illiquid, long-term, new, and then we have to value them and make sure we come up with a fair price that is fair for the government and fair for the investors. That's hard, right? And so it is, in my view, critical that you have inside the government a team of experts that understands very clearly what are the different risks and potential rewards of these infrastructure projects so that they can negotiate the best deals for governments. And this is actually another value add of having these infrastructure banks that operate like private sector institutions on behalf of the government, because they understand some of the subtleties in these markets, and they can help the government get fair deals in these projects so that you avoid a situation where 5 years later it feels like it got the short end of the stick and no longer wants to enter these types of projects. So that's one, is having a team of experts inside the government who understands the private sector and can get a good deal. The other piece I would say is having a good communication strategy at the government level about what is it that you're going to do with those funds that you just received. Because when you are raising funds by selling some of these assets or having some of these these private investors coming in and develop on behalf, it gives you more funds to deploy for other projects, building schools, building hospitals, building more infrastructure. Make it clear to the constituents that you've actually were able to make use of these funds, because otherwise nobody knows.
Canada cautiously embraces privately funded infrastructure when we compare us against our peers. What policy shifts are needed to better unlock private capital sitting on the sidelines?
Cautiously, yes. But historically, Canada in infrastructure has not been a very conducive environment for the private sector. If you look at our airports, our ports, our utility companies, our transmission lines, most of those are owned by government. By contrast, if you look at India, Australia, the UK, the US, there's a lot more private ownership of these entities. I think moving forward, we need to have a government commitment, especially in these new types of green infrastructure markets, that there is support for private sector to come in. And perhaps even more importantly, we need to have an integrated policy framework. If you go back to the infrastructure goals of Canada back, I think in 2015, 2017, there was about close to $200 billion allocated to infrastructure through about 20 departments and agencies. And then you have a few infrastructure banks. You had the CIB, the Canada Infrastructure Bank, that was created in 2017, the Building Ontario Fund that was launched in 2023, the Canada Growth Fund as well in 2023 or so. You had in the latest budget in December, you had the announcement of new funds being created to facilitate new data centers as well. So the more entities you have, the more risk there is for competition among these agencies for projects as opposed to coordination. So it's critical that we build a coordinated framework. And if we don't have that, and you are a private developer, and you have a department coming to you and offering you a grant, or an infrastructure bank coming to you and offering you a loan, well, you're going to go for the grants because it comes with fewer strings attached and you don't have to pay it back. And so the building that coordinated framework at the policy level is critical in order to get the greatest use of our taxpayer dollars and, I guess, maximize the capital coming from the private sector to deploy in these new markets.
How can Canada ensure its growing network of infrastructure banks and grant programs complement each other instead of compete with each other?
Have a very top-down government approach where we look at the portfolios of these agencies and banks. We understand what are the territories on which they're operating and what are the rules of conduct about which agencies or which banks intervene first with private capital, depending on the needs, depending on the investability of the project, so that ultimately we can make the greatest use of our different levers to maximize the private capital in these new infrastructure markets.
Sebastien, thank you so much for your time and insight today.
Thank you, Michael.
Sebastien Betermier is an associate professor of finance at McGill and the executive director of the International Center for Pension Management. Read his commentary, Breaking the Catch-22, How Infrastructure Banks Can Kickstart Private Investment and Overcome Market Failures, at cdhow.org. I'm Michael Hainsworth. Thank you for joining us.
You've been listening to the C.D. Howe Institute podcast with Michael Hainsworth. Subscribe on iTunes, Google Play, and Spotify. The C.D. Howe Institute is an independent, not-for-profit research institute whose mission is to raise living standards by fostering economically sound public policies. The Institute is widely considered to be Canada's most influential think tank and a trusted source of essential policy intelligence, distinguished by nonpartisan, evidence-based research and subject to definitive expert review. Visit cdhow.org and follow us on Twitter and LinkedIn. Thank you.